Here's an explainer for essential question number 1 that we did on August 1st during the summer of 2011. This one is just a small coffee shop in Portland. So a delivery of coffee is made as long as an invoice to you. What you have is an increase in inventory, so your assets are going up. And at the same time, it's bounced off by this increase in liabilities. That's what the invoice is. It's your balance sheet balance because your assets always have to equal to liabilities plus owner equity. And then what happens then is you notice that you did get some assets. So if you split that transaction up, you'd have a decrease in cash from investments. But at the same time, that supplier lent you a little bit of money, so you have an increase in cash from finance. Easy catches you in 4 spots, and that's one of the classic transactions. Question number 2. You give your employees a raise, and so what we're looking at here is you've got some increase in expenses that are going on. That reduces net income, and what you're going to see is a decrease in cash from operations. So that's the echo through that goes on there. Just remember, anything that happens on the income statement ends up usually on cash from operations. Question number 3, you increase the price of a regular cup of coffee and there's no decrease in sales. Yay us. Revenue goes up. That means net income goes up. That means cash from operations increases. That sounds like a good day. Question number 4, you have a customer with a large $1,000 tab and you just paid it off in cash. Well, what you're doing here is that client had an account receivable for you. It's an account payable for him. So what's going on is that the tab's getting paid off, so that particular asset's going away. It's being replaced by another kind of asset, cash. So remember, this thing here on the balance sheet balances itself out there in the asset section, but you know that cash is on one side of the transaction, so there better be something in the cash flow statement. In this case, it used to be that you had a decrease in cash when you lent him money, but now what's going to go on is you have an increase in cash from finance as he paid off that chunk of the loan, which is pretty easy. Switching back over to black, I don't know why it is that Vegas tends to show up in a lot of my examples, but what you're going to do here is you're going to take money out of the business and go to Vegas. So there's the cash that's going to decrease you have inside the business, and it's offset by this decrease in owner equity, so that balance sheet stays balanced. Remember that anytime or rather most of the time you see changes in liabilities and owner equities, it's got something to do with the change in finance. And so what you're going to see is a decrease in cash from finance over here too. Number 6, you lend $10,000 to the bakery across the street, a small little business loan. What you do is you have a decrease in one kind of asset, cash, and an increase in another kind of asset. This is like a little note payable or something along those lines. At the same time, because you're lending money, what you're going to have is a decrease in cash from finance. That's where you do the borrowing and lending. Remember, cash went out the door, so there should be a decrease. The other one is you take $20,000 out of my machine. This is going to be translated in one kind of asset into another. You see an increase in fixed assets, investment funds, an increase in the cash reserve because you saw cash out there and there was something on cash reserve. So there's a decrease in that. And then finally, a delivery of milk is another piece of cash flow. So here we'll go increase in milk assets, decrease in cash assets. You saw cash, decrease in cash. And that should do it for simple question number 1. The other one is we did this on August 1st, 2011 during the summertime.